As every financial professional is acutely aware, the big story in asset management in recent years has been the growing popularity of index funds. Outflows from actively managed funds hit a new record in 2024, smashing previous records set in 2023 and 2022. Our guest on this episode understands this trend inside out. Tim Edwards is Managing Director and Global Head of Index Investment Strategy at S&P Dow Jones Indices. Among other things, he manages SPIVA, S&P's ongoing scorecard for active fund management around the world. He holds a PhD in pure mathematics from University College London. Tim will be telling us how index funds have revolutionised the investing market.
You have an increasing number of investors who have saved money on management fees by moving from high fee products into much lower index fund-based products. The figures are of the order of over $20 billion a year saved in fees.
He'll explain why the current domination of the S&P 500 by large tech stocks is actually not that unusual.
At the end of the 19th century, railroads were more than half of the US equity market. And in fact, US railroads were among the most traded stocks here in the UK and made a significant proportion of what was available to trade as listings on the London Stock Exchange.
And he'll be giving us his opinion on when the shift towards indexing will eventually run its course.
I suspect that eventually we will reach some form of equilibrium where a certain proportion of the market is invested passively, a certain proportion of the market is not. However, we do still appear to be in a period where the movement from active investing to passive investing continues globally at a relative pace.
Here then is my interview with Dr. Tim Edwards. Tim, perhaps you could start by explaining what S&P Dow Jones Indices actually does. What do you bring to the table, if you like?
So S&P Dow Jones Indices is an index provider. We are one of the first index providers, and in fact, the first financial market index was the Dow Jones, began with a railroad average at the end of the 19th century. The slightly more famous Dow Jones Industrial Average came a little bit later, 1896. We're perhaps better known today for the S&P 500, which is a US equity index that launched in 1957. And we offer nowadays thousands of indices representing markets around the world, different bond markets, equity markets, commodity markets, and so on. So our role is to provide the index, but then we have partnerships, commercial relationships with fund providers and others who will offer actually products that might track one of our indices, like, for example, an index fund. So we don't ourselves offer a financial product. It'd be a fund manager, and they will license the right to use our index, our data. And so then when you see a product out there that's an index fund, you'll see a fund provider, and it's an index fund tracking the S&P 500, for example, and that indicates that they've licensed the right to track that index from us.
Now, as Managing Director of Index Investment Strategy, I think I've got your job title right there. One of your main roles is to manage SPIVA.
Yes.
Now, I know what SPIVA is. Other people watching and listening may not know what it is. Can you explain?
Yeah, so SPIVA continues a tradition that's actually much older. But SPIVA, first of all, it's an acronym. It stands SPIVA, S&P Index versus Active. And the versus active, what does that mean? So SPIVA is the brand name for a series of global reports that answer a simple question and also answer some more complicated questions. The simple question is, how have actively managed funds around the world been doing in comparison to their benchmark? I mean, one of the fundamental value propositions of a stock picker, of an active manager, of a smart investor, is that through their choices, through their research, they will be able to make selections that will do better than average, right? What's the average? Well, the average is the overall market represented by a market index. So index versus active, the notion is we will look at all the actively managed funds and regularly report over the past 6 months, 1 year, 5 years, 10 years, and so on, what proportion of actively managed funds have delivered on that hope of performing better than an index. That's the simple question we answer. The more complicated questions we look at are, for example, why? How are different active funds performing in different market segments, from emerging markets to domestic equities to fixed income? What have been the market factors that might have been playing out? And what are the drivers in the statistics that we're seeing? But as I say, SPIVA, it's been running as a research report for more than 20 years in the US, more than 10 years in Europe, and we cover 9 global regions. The most important thing we do is just give people an updated sense of how active managers are doing versus indices around the world.
As you say, you provide a scorecard for active managers all around the world. But broadly speaking, I think it's fair to say that your findings are pretty consistent all around the globe. And what are those findings?
Well, there are some observations that you can make which are consistent around the world and across asset classes. The first is that over the long term, and by long term, I mean 5, 10 years, even 20 year statistics we'll publish in some markets. Over the long term, statistically, very few actively managed funds manage to outperform an appropriate benchmark. In the short term, there's a much greater degree of variability. It's almost like, it's almost a law of averages thing. The long-term numbers are very similar around the world. And by very similar, what I mean by that is it is rare, if not it is unusual, I shall say, and it is rare to find a fund category which over 10 years you will see less than 75% of managers underperforming. It is common to see statistics in the 80, 90% underperformance. When in the US that you go out to 20 years, it really does become very compelling statistically. Typically 9 out of 10 managers underperforming at the index. So, and that's something we've seen across asset classes all around the world. On the shorter numbers, we see a much greater degree of variability, and that's often, the headlines will run with that. You are on average going to see a number across all the statistics somewhere, but slightly more than half, maybe 2/3 is a typical short-term number. But we will see numbers ranging from nearly all managers outperforming over a short-term horizon to nearly all managers underperforming.
But of course, most investors are investing for a very long time. I mean, new investors today may be investing for, the next 60, 70, 80 years or more even. The crucial stats are the very long-term stats, and certainly the likes of David Blake at Bayes Business School, French and Farmer in the United States, suggest that the number of outperformers on a cost and risk-adjusted basis over the very long term is somewhere around 1% to 2%, something like that. Now, you're talking typically 90% of funds underperform over, say, 10 years. The data for the US has only been going for 20 years. Do you expect, say, I don't know, whoever replaces you in sort of 10, 20 years' time at SPIVA, he will be talking, or she will be talking then about figures of around 1% to 2% over, say, 40 years?
It's a great question, and it's something that I personally and many people in my team are sort of interested in. What's driving those statistics, and will those factors continue? First thing we can say is SPIVA, as a research report produced by me or my predecessors, it does have a prehistory in academia. The first Spiva-like research piece that I'm aware of was actually published in 1933. And there was another little flurry of activity in the 1960s and 1970s, largely academic research looking at exactly the same question. What is the proportion of mutual funds? Then there was no such thing as an index fund. There's just funds. Or prior to that, in the 1930s, it was actually newspaper stock recommendations and insurance company institutional portfolios. And the statistics qualitatively were very similar. They found in the 1930s, they found in the 1960s, we found in the early 2000s, we continue to find in the mid-2020s that it is statistically very difficult to outperform the market in the long term. Could those numbers change? Look, never say never, but you have almost 100 years of evidence and data that suggests it has been hard to beat the market. And it might be worth just sort of adding a little more on what grounds there might be to suppose, kind of economically, why it might remain hard to do so. And because there are some. And they begin with a very simple, intuitive concept, and that is just revisiting what does it mean to be above average. I can be above average, you can be above average, but we can't be both above average in terms of just the two of us. If one of us is above, another has to be
You're above
below.
me, Tim, definitely, on most counts anyway.
Well, I think it depends what we're measuring. But the point remains that we can't be both above our average. So if you take all the funds, all the different investors, they all together, their average is the average. Some can be above, some can be below. But that's in a pure academic measurement sense. If you think about fund performance, what the investor actually receives, there are other frictions involved. In particular, there are fees, trading costs, research costs, portfolio, the cost of hiring smart people to run your money for you. And once you factor in that, you see that it must be, by pure mathematics, it is difficult for many people to be above average. When you compound that over time, so look, a 1% fee is reasonably difficult to make up on its own, but over 2 years cumulatively, that's 2%. Over 3 years cumulatively, 3%. Over 33 years, it's a third of your initial capital that might have been paid away in fees. And so you really have as the time horizon extends, the challenge of, if you like, first of all, staying alive, surviving as an investment vehicle, and overcoming those cumulative effective fees. That's a really important factor in the historical statistics. And provided that it remains relatively expensive, or as there are fees, one might suppose that the Spiva numbers produced long into the future will be broadly similar.
You mentioned that back in the 1930s, it was Alfred Cowles III, I believe, who actually demonstrated statistically that forecasters generally got their forecast wrong and wouldn't have beaten the market, if you like. Of course, lots of things have changed since then. I was talking to Charlie Ellis the other day, who wrote this famous paper in 1975 about active management being a loser's game. And he was saying, for example, back in the 1960s, of course, much later than the 1930s, actually, there were still quite a few amateur investors, mom and pop investors, as they call them in the United States, trading. But now 90% or so of trading is actually done by professionals. Yeah. We've seen this huge growth in the number of professional stock pickers all around the world. We've also seen the equalization in terms of access to information. We all get access to the same information at exactly the same time. And the final point that he raised was the improvement in technology, that actually we've got much, much better technology now, which enables us to access the very latest information and assess the very latest information. He thinks it's getting even harder to beat the market. What would you say to that?
It can be important sometimes to ask ourselves the question, what does it mean to be smarter than average? What does it mean to beat the market? Like, which average are you trying to be better than? There are trillions of dollars exchanging hands every day on the stock market. Trillions, and $1 million is a slow day, and decisions are being made in microseconds, in milliseconds. When there is an important announcement, be it an individual company's earnings or a decision from the central bank, if you watch that decision on the news and think, oh, okay, I think this means prices will go up, prices will go down, and then go log into, you're too late. The professional investment managers have evaluated and acted on and realized the impact of that decision in the time it takes to blink. There are thousands of really smart people with fiber optic cables sitting right next to the exchange who are trading thousands of times every second. That's what it means to have an edge, to be the fastest. It's not impossible to be lucky or to get things right, but it is to have that edge is incredibly difficult. You mentioned the history, and Charlie Ellis, who helped, or at least I think was one of the first presidents of the CFA Society. Financial analysis is an important profession. In the 1970s, the first chartered financial analysts were getting their spurs, as it were. There's over 100,000 CFAs today, and I think a similar number taking exams. That the professionalization of the financial markets has been one of the major trends that spans over the decades since the 1960s. The increasing difficulty to be the smartest, to have an advantage, is something that I think is deeply underappreciated by people. It may look from the outside like a random walk, and it's actually very useful to think of it as the market is on a random walk. But what it is doing, microsecond to microsecond, is reflecting the average consensus opinion among thousands of financial professionals.
You make a really important point, Tim, about the speed with which the financial markets assimilate the very latest information, which is why I find so amusing these articles we're reading right now about how investors can make the most of Donald Trump being the new president of the United States. I mean, we've known for many months now that he was probably going to be the president of the United States. He was confirmed back in November as the president, and markets instantaneously responded to that likelihood and any new information along the way, as you say, within milliseconds, and yet people are still now trying to work out how they can sort of benefit from it. You really are too late once people are already talking about, the latest investment idea, aren't you?
You're absolutely right in terms of the speed with which financial markets process information. But that's not necessarily a daunting thing, because it's not necessarily the case that your job is to be faster than anyone else. And let me explain what I mean, because it's not just not a bad thing, it can actually be a good thing. Now, suppose, for example, you had a tracker fund that was associated to a well-known popular index. One of the indices that reported in the news that sees a lot of trading volumes and is closely scrutinized. Okay, well, while you're holding that investment, while you're tracking that index, you might hope that the rest of the world, that all these smart people are keeping a close eye on exactly what the impact of a US election or an interest rate change might be, what the fair price for your investment, should you wish to exit it, should be. And you should hope for, and wouldn't it be wonderful if there were lots of people competing to offer a competitive price for what the right value should be. And if your plan is to hold for a long term, what a community engaged in that particular index can do is offer a level of scrutiny. How is that index constructed? When should a new company join? When should an old company leave? What happens with dividends? What happens with new companies? What happens with mergers and acquisitions? What is the right response to an earnings announcement? What is the right response to a CEO? So both in terms of the price of the individual components, the construction of the index, the methodology, does it continue to reflect the market, et cetera, et cetera. And so there is a sort of network benefit in terms of transparency and scrutiny, that you can then potentially, I wouldn't ever say, relax, but have some degree of comfort that the index that you're following is also being watched and scrutinized by some very smart people. And any mistakes, inaccuracies, inefficiencies are being, if you like, ruthlessly policed by an army of professional investors who are incentivized to spot anything wrong and take advantage of it.
I think something that investors don't properly appreciate is just quite how many funds there are. There are lots of funds. There are more funds, in fact, than there are individual securities, which I always find just absolutely staggering. So it just stands to reason that at any one time, just by chance, random chance alone, there are always going to be some funds out there that have performed over relatively short periods. But as your SPIVA analysis shows, they generally are short periods. These are like shooting stars. They fizzle out really very quickly, don't they? Generally speaking.
So there's a companion to our SPIVA scorecards, which goes under the name of the persistent scorecard, which digs into this question. And by this question, I mean, is it true that, sure, over the medium to long term, you see few funds are managing to beat the index? Are they the same funds? I.e., could you identify them in advance by simply looking at the ones that were doing well before? Which, incidentally, it's quite an intuitive notion. It seems quite reasonable to me to suppose, well, fine, many managers, many investors don't beat the index, but there are some smart ones out there who do, and they will do so consistently. The persistent scorecard looks at the following question. If you, over any historical period, took the top half of performers, or the top quarter of performers, or the ones that had historically beaten the benchmark, if you looked at them compared to their peers, are they any more likely to do better? And conversely, do the bad ones stay bad, right? Is it the case that you have some very foolish investors out there who are somehow offering their services and being below average so that someone else can be above average? What our persistent scorecards have shown year after year, region after region, is that statistically you are no better off with a fund that has performed well than you are with a fund that hasn't. There is genuinely no evidence of persistence in outperformance. Within that, I should qualify, as I say, we have SPIVA statistics, underperformance statistics that range up to 20 years in the US. And it is the case that in most instances, very few funds have beaten the index. But I say very few, not no. In almost every category, you will find 1%, 2%, 3% of funds that have been able to beat the index, over 20 years. And I think that something to bear in mind here is there are many different kinds of funds, many different kinds of strategies. Looking back historically, there will be some kinds of investments, some particular baskets of stocks, naturally, that will have beaten the index. The challenge is not to say, is it possible? Not always, but it's nearly always possible, right? To get ex ante, historically, you could have done that, and turns out someone did do that. The challenge is to identify in advance. And that's where this persistent scorecards come in, because it shows you how difficult it is to identify in advance that very small subset who will likely exist, but unfortunately it's a little bit needle in the haystack.
So as the disclaimers always tell us, past performance is no guarantee of future performance. In fact, what you're saying is it doesn't tell us anything about future performance at all.
The disclaimers are true to their word. Yes.
And actually, because I know at S&P Dow Jones Indices you also do research into investment styles. Very often a fund that has performed very well in the recent past may just be the fund that is going to perform badly in the short-term future because it has a style that has worked well, but styles inevitably fall in and out of favor. And so very often buying a fund that has a stellar 3-year record, say, might be a very bad thing to do.
One thing that we have seen, and the industry is rather aware of, is that a fund or an investment strategy that has strong recent performance tends to attract investor attention. And I think this is very normal human behavior. Who's interested in looking at something that's been doing really badly? Like the things that have been doing well attract our interest, attract our attention. What I think is less obvious is considering, first of all, the cycles or the regime shifts that we do see in markets, which means that if value has been doing very well recently, it's quite possible that value will not do very well in the near future. It's not guaranteed, but there is in financial markets a degree of reversion to the mean that you see across markets, and timescale is very difficult to determine. So I think that's part of it. Things that were doing well don't keep doing well. There is something else which is less obvious, that it is quite possible that a certain strategy which works with a small fund doesn't necessarily work in the same way when that fund becomes much larger in size. And so there is the potential for a sort of change in the actual way a strategy works, simply because the performance is good, it attracts a lot more investment, but then the strategy itself becomes a little bit more awkward in how easily it can navigate its own style.
In my experience, Tim, one of the main reasons why people tend to overestimate the odds of success through active management is survivorship bias. You were talking earlier about it's not just difficult for a fund to outperform, it's difficult for a fund to stay alive. And that's certainly what your data tell us, isn't it?
In order to understand the data that we often see in terms of investment performance, understanding survivorship bias is absolutely critical. So what is survivorship bias and how important is it? Survivorship bias is the following. If I were to go out today to any provider of funds, or in many cases other investment contexts, cryptocurrencies, whatever it was, and if I was to show me the 20-year performance or the 30-year performance of everything that has a 30-year performance, here's what you'll find. You'll find that actually that set that has a 30-year performance is often, it will show quite decent performance. Okay, great. So the 30-year record of funds or whatever is great. Here's what survivorship bias is. It's the bias that comes from the following. 30 years ago, there might have been many more choices that you could have made that are no longer available because those funds at some point in the 30 years disappeared from the menu. And in fact, the bias comes from the fact that it's not typically the funds that have a great track record which disappear from view. It's the ones that haven't done so well. So our SPIVA scorecards do something very important. In order to calculate our statistics, we start, if you're looking at how many funds beat the index over 10 years, for example, we'll start by looking at all the funds that were on sale 10 years ago and see how many survived and how many didn't survive. And it's important because the survivorship rates are materially below 100%. Materially, out to the 10-year point, it is not uncommon to see, for example, average across all the categories we measure, something like 1/3 to 2/5 of funds don't survive the period. So that means that when you're looking today at all the funds that have 10 or 20-year records, you're looking at those funds that in the first 5, 10, 15, 16 years had a performance record that was sufficiently good to mean that they continue to attract investor attention. So-called survivorship bias is super important. It's deeply, fundamentally important to understanding how things work in finance more generally. And if you were to look at the stock market today, what you see is the stocks that have survived. They don't include a long tail of all the thousands of companies that don't exist anymore. If you wanted to, we never see interviews with people who didn't win the lottery talking about their experience. There is a really strong bias that attracts our attention towards the things that have done well, the things that have survived. And it's fundamentally important to understanding the real prospects of individual success when you're making your own choices.
Something else, another bias that obscures our view of how things really are, if you like, is outcome bias. We assume that because we can see a particular outcome, say a good outcome, a fund has done particularly well, then the reason it did particularly well was that the manager was, very smart, or he picked the right stocks, or timed the market, or really covered himself or herself in glory, if you like. But very often, outperformance can be just down to random chance, and people can easily confuse skill with just plain luck, can't they?
Look, there's a great cartoon which I'll credit the comic XKCD, and it's someone's giving a motivational speech, and they say, the people said there was a low chance of winning the lottery, but I just kept trying. We do structurally confuse luck with skill. The way to distinguish whether it's skill or luck actually is to look at the question of persistence. So is it any more likely that someone if skill exists, someone with a good track record is more likely to continue their good track record, right? Oh, sorry, I shouldn't say if skill is more important than luck, not just if it exists. If it exists, then it's important. So actually looking at persistence is a really important way of distinguishing whether luck or skill is more important in determining outcomes. And I mentioned our persistence scorecards. One of the things we do, and it's a very simple measure, and we do it because it has a simple comparison. So you look at the performance of funds, and you ask, were they in the top half or the bottom half compared to their peers over the past 3 years, over the past 5 years, whatever it is, right? And then in the next period, were they in the top half or the bottom half? Now, if the only thing that was important was luck, not skill, that would look like a coin toss. It would be a 50-50 chance of going from the bottom to the top, or the top to the bottom. What our data has shown over more than 10 years of producing the reports is that persistence in this sort of top versus bottom half is indistinguishable from a coin flip. The number is incredibly close to 50. 50 is statistically indistinguishable. That tells you that luck is a really primary driver in compared to skill in the relative performance of actively managed funds.
Is there any evidence at all that fund managers in any particular country are any more skillful than fund managers in another? When I first started writing about these issues 13, 14 years ago now, I remember having a conversation with someone from a very well-known UK financial organization, saying, what you're saying, Robin, is all very well in America, because we know active funds struggle in America, but here in the UK, we have some very, very good fund managers. It doesn't work like that, though, does it?
First of all, it's true that there is a perception that different parts of market segments are more suited, if you like, or active funds are better advantaged than others. However, here's what our data tells us. The most recent data speaking now is up to the mid-year point of 2024. And let's compare what is, I think, generally perceived as one of the world's more efficient markets. So US large cap equities versus the S&P 500. And we'll take a 10-year statistic. So in the 10 years running to June 2024, 84.7% of US large cap actively managed funds underperformed the S&P 500. Okay, 84.7. And the equivalent for the United Kingdom, so the UK large cap equity active space, that statistic over 10 years, how many funds underperform the appropriate benchmark? 84.0%. Different? Yes. Materially different? No. And that's just the latest statistic. Again, looking over those longer term data, there is not a material difference between the beat rate, if you like, the hit rate, if you like, of outperformance in UK stock markets compared to the US stock markets, compared to actually many other major markets around the world.
When people talk about active management, they're generally talking about equity management, but there is active bond management as well. What does your data tell us about how well or badly active bond managers perform?
Yeah, so we've increasingly covered the fixed income side of things. When SPIVA began 20 years ago, we just looked at the equity markets, and there were fewer index funds for the bond markets available. Over the past 2 decades, that's really changed. Index funds came later to fixed income, but the path is very similar, just sort of a few years later. And increasingly, there's a relevance and a resonance to looking at this question of, how do active funds do versus appropriate benchmarks. Increasingly, that question is being asked in the fixed income markets. There are a couple of things that are interesting and different about the fixed income markets. The first is in terms of the sources of return and their reliability. Let me explain briefly what I mean. You might have a manager or doesn't even have to be, it might be an advisor, who has a preference or a liking of the value style of investing, i.e., not going after flashy companies, but looking at valuations, looking at fundamentals. Or you might have, an interest in looking at smaller companies from a perception that over the long term they'll give you a higher risk return, a higher return, perhaps a little bit more risk. The thing is, when you go in, on day one, you might buy a value company, you might buy a smaller company. You've got no idea what sort of return benefit you might get from that. Now compare that to the fixed income markets. And what I mean by that is, suppose your benchmark or what you were really thinking about was a 5-year UK government bond. And let's suppose that had a certain yield, like 4%, hypothetically. Now, UK government is a very good credit. It's a very creditworthy issuer in terms of sterling bonds. If you were to look at a corporate issuer with a similar maturity, who is not the UK government, there would probably be a higher yield. You might get a 4.5% if it was a good credit UK corporate. You might get 5 or 6 or 7% if it was a slightly riskier investment. Or you might look alternatively, rather than looking at less secure credits, you might look at different time horizons. Even for the UK government, for 5 years, maybe you get 4%, but for 10 years, right, if you lock up your money for a little longer, perhaps you're getting 4.5%. Now, why do I labour the point? If you hold the bond to maturity, and providing there's no default of either the UK government or your risky company, the additional return you get is right there. It's very clear. right? You get a 4.5% instead of 4%, or you get 5% instead of 4%. It's very clear and obvious what the additional return premium you're going to get is. Accordingly, and sort of you can see this statistically in performance, if you think of an active fixed income portfolio, you will often see that, the way that benchmark outperformance is being sought is either through taking perhaps a little bit more longer term investments or a little bit more credit risk. And provided nothing awful happens, that will generate an additional return. However, that additional return is not going to be the difference between putting in a real winning stock or a real losing stock. It's more likely to be the difference, at the kind of scale of water, an extra 20 basis points or 0.2% per annum. If you are charging a fee that is larger than that, you almost have no chance. So we found in our SPIVA statistics that the underperformance rates in fixed income over the long term are similar. You're still seeing, they're different, but they are similar. You're seeing, 3/4, 4/5 or more of actively managed funds underperforming. But some additional analysis we did showed that actually before fees, the record of active managers in fixed income was much better. So there does seem to be, and again, that's over a period where nothing really awful has happened. We haven't seen an awful lot of defaults. But over the past 5, 10 years and 15 years, really going back to the financial crisis, it has been possible for active bond managers to generate a little amount of outperformance, possibly by taking on a little bit more risk that was not realized. The challenge is, again, the drag of fees is so much more important than fixed income because the additional returns are much more limited than they are in the equity markets, where a winning stock really can be a multiple of benchmark performance.
We've seen some interesting developments, haven't we, in the bond markets in recent times. There's, I suppose, been a bear market in bonds since 2020. UK government bonds were badly hit at the time of the Liz Truss budget. And indeed, in January 2025, there has been considerable volatility in the global bond markets, and particularly the UK gilt markets. What does the evidence tell us about whether active managers shine or otherwise during these sorts of periods?
So one of the things that you'll hear, and it's certainly true, is in times of market disruption and so-called bear markets or times of high volatility, times of market disruption, you will hear the following. You'll hear there is more opportunity for active managers. It's certainly true. You'll also hear it in periods where one part of the market does particularly badly. For example, one often reads the example of the tech sector in the late 90s and how an actively managed fund might have avoided too much risk in a frothy sector by under-allocating. And that's definitely true. The challenge is that opportunity for glory is often accompanied by opportunity for embarrassment. The history of all financial markets is potted with periods of extreme uncertainty, volatility, and the Liz Truss mini budget and the response in UK government bonds was a real example of that. In these periods, when prices swing dramatically and differ enormously, there is clearly opportunity for outperformance, opportunity for some to do very well. Unfortunately, there has to be a commensurate opportunity for embarrassment. Remember, we still have the law of averages to deal with. And if anyone is above average, by whatever amount they are above average, in aggregate, there need to be enough people below average. Otherwise, the average is not the average. Statistically, what our data shows in terms of our SPIVA scorecards, our persistent scorecards, our own analysis, is exactly that. periods of volatility tend to generate more extremes in performance, i.e. funds that either through luck or skill did well tend to do even better in terms of returns. Funds that do badly tend to do more badly in terms of their differences to average. Survivorship rates tend to lower. So periods of high volatility tend to see more funds being wound up, capital return to investors, possibly because of bad performance. So it's sort of both things are true. It remains true that those periods do represent periods in which the opportunity for outperformance is greater. However, that doesn't suddenly mean that people who were going to be unlucky suddenly become lucky. It doesn't suddenly mean that people who had no skills suddenly become skillful. In some sense, it just raises the stakes. And it also, I think this is perhaps underappreciated, these kinds of periods can be those in which diversification becomes more powerful. Navigating turmoil, navigating choppy markets. Look, in some cases, there's not much you can do, but at least diversification can make sure that you're not overly exposed to any one part of the market. And you might hope that at least if many things are doing badly, some other things are doing well. So rather than focusing on outperformance, perhaps thinking about diversification in these times can be something that has a better chance of first of all, giving you a smoother journey, but also giving you a closer alignment between what you hope might happen and what actually does happen.
Almost every fund manager reverts to the mean in the very long run. I mean, it happened to Warren Buffett, perhaps the most famous investor of modern times. It happened in spectacular fashion to Neil Woodford. It happened to Anthony Bolton. You could say it's happening to Terry Smith, to Nick Train, all these other stars, pretty much all of them. There are just one or two outliers. A fund that's often mentioned to me, for example, is the Medallion Fund, a hedge fund which was founded by the late Jim Simons, which actually most investors can't actually invest in, which is not a fat lot of use anyway. But it does seem to be a real outlier.
There are outliers, you might call them, across financial markets. This occurs both on individual stocks and in the case of actively managed funds and hedge funds, or even very private pools of capital. Our SPIVA data, as I mentioned earlier, even over the long term, we might report 99% underperformance, but there's normally a 1%, right? Very often you'll be able to find one or two outliers. Here's what's important. First of all, is it feasible for us to hope that among those 100 funds, an advisor, is going to be able to identify that 1 in 100 that is going to outperform in the future? And secondly, is it actually, when you're talking about this or that hypothetical pool of capital over there, is it actually a viable option? Is it open? Is it possible to access? I think it's very possible that there will always be outliers. Identifying them in advance is very difficult. And I'm not sure how helpful it is to talk about investment strategies or funds which are may have great performance, but are practically we don't include it in our SPIVA data because it's not actually available for anyone to invest in.
Index funds are not perfect. And one of the reasons why is something called the index effect. Tell me what that is and how significant it is.
Yeah, thank you for asking. It's good to have a chance to explain what our research shows about this so-called index effect. First of all, what is it? So over time, indices change. The 500 companies that make up the S&P 500 today are very, very different to the 500 companies that were first in there when it began in 1957. Over time, indices will add new companies and older companies will depart. Certainly in the case of the S&P 500, which by definition only has 500 companies. The so-called index effect is a pattern whereby companies that are identified to join the S&P 500 see an increase in their stock price when they're selected to join the index. And companies that are kicked out of the S&P 500 might see a decline in price. And so there is a pattern which occurs on average, and which could potentially be of importance to people who are tracking the index, right? If, say, it's going to join the index, price goes up, people tracking that index, maybe they're buying at a higher price, and maybe that's sort of bad in the long term for them, versus a different strategy that perhaps traded in advance or bought things before they went in. So it is something that is there, and actually, historically, perhaps intriguingly, if you look back 20 years ago, 25 years ago, when there really wasn't much capital following index funds, the magnitude of the index effect was more material. We have actually published research on this that it's available for free. The title of the paper is "What Happened to the Index Effect?" And the reason it was titled "What Happened to the Index Effect" is because nowadays, on average, the impact on a company of being added to an index or being deleted from an index, it's still there, but the impact is very, very small. I'm talking fractions of a percentage point. Now, how material is that? So, over the past 10 years, the S&P 500 portfolio has, on average, each year, seen about 2% of turnover. 2% of the portfolio companies going out, 2% companies going in. Okay, so you're thinking about the trading that would be required to track that index. You're trading, on average, past 10 years, about 2% of your portfolio every year. On that 2%, again, just looking at the actual price changes that we've seen in companies coming in and coming out, and it is a percentage point of a percentage point, right? It's 0.0 something percent, and that's on 2% of trading, all of which added up. The actual impact is very, very small in absolute terms, but it's important to acknowledge it, and it's important to say that this is part of it. And why I think it's important is not all indices are built equally. There are index funds that follow different indices that might have higher levels of turnover, or active funds that have higher level turnover. And asking the question, if I am buying and selling within my fund, I should expect that to have an impact in the market. I should expect that to have some cost. There's no way to completely remove it. However, following a market capitalization weighted index, where your investment is scaled to the opportunity set in front of you, is one way potentially of making that de minimis. So in some sense, I would say the index effect shows you that even index funds are not completely immune from questions of, what's my capacity, what's going to be like running this strategy. But the data does suggest that the actual performance of that at the index level, while it was more material 10, 20, and especially 30 years ago, is very small today.
We've seen a huge growth in the popularity of index funds over the years, and that has accelerated in recent years. 2023 was a record year. The outflows from active funds into index funds, that record was smashed in 2024. Who knows, we might have the same this year and next and beyond and so on. There are suggestions that all this is having perhaps negative effects on the markets, on the functioning of the markets, on even capitalism in general. What are your thoughts on that?
I think there are a few things which we might consider as important consequences of the increasing adoption of index funds. The first, and perhaps one of the most material, is to take a step back and ask, okay, well, what's the impact been for the market overall and for investors overall? And that is very, very clear. You have an increasing number of investors who have saved money on management fees by moving from high fee products into much lower index fund based products. We have published estimates that, and just to put some dollar figures on this, We do an annual estimate of how much money is in index funds tracking the S&P 500 and how much money is being saved compared to the average investment in an actively managed fund and the average fee that that's associated to. The statistics or the figures are of the order of over $20 billion a year saved in fees. Our speed of statistics also suggests that tracking the index would have given a better investment performance than an investment in the average, if you like, or the median actively managed fund. So I think it is arguable that the rise of index-based funds, one of the most important consequences has been better outcomes for many investors. A second important consequence comes back to this whole question of what does it mean to be above average and requiring someone to be below average. And I'll make a claim. I don't know if it's certainly not always true, and it may not be that true on average. But who are these people who are buying index funds? In some cases, they will be people who have been disappointed by their own performance trying to beat the market, or the appointments of the agents or managers that they've appointed. And if you do believe, or if you think there is some aspect of skill involved, then what that means is those who were underperforming, those who were unskilled, are no longer providing the market with the opportunity to exploit them, because they are just now following the market average. So they're getting the average, they are no longer below average. A consequence of that means it is harder for the remaining active managers to outperform. The average intelligence just went up, the average skill went up, the average performance went up, so being above average just got harder. So that's a second important consequence. The third important consequence, and again, I think this one is deeply underappreciated, is that the choice of indices and markets which are available in terms of an index option or an index function has broadened tremendously. So that nowadays there is a very broad menu of different asset classes, different segments of the markets for which there is a low-cost index fund alternative. I think it is hard to argue that any of these are unfortunate consequences for the overall markets and for market participants in general. And the last thing I think it's probably worth pointing out on this is the users of index-based products are not just stereotypical long-term buy and hold investors. In fact, among the active community, we are seeing increasing usage of index-based products. An example might be sector-based funds, which tend to be used quite tactically by different investors. Or you might think about the existence of futures contracts or options contracts tied to indices like the S&P 500. So in that sense, the sort of popularity of indexing, of passive investing, is somewhat overstated, because they are also being used by traditional active investors. And in fact, that's quite normal, that's quite usual, and that's been a long part of the history of indices when you think about something like futures.
Question I'm often asked is, what would happen if everyone indexed? How would you answer it?
I mean, it's a very hypothetical question. The best estimates we have is that something like 1/3, and with a very wide margin of error, but something like 1/3 of the US equity market is currently invested or being held within an index-based context, and that is possibly the most indexed market in the world, if you like. The one that's the US large cap equity is probably the most highest proportion of index funds. So we're a long, long way away, and I think it is a very, very hypothetical question. Never say never. What would happen if everyone indexed? There was a wonderful headline in a satirical, I won't say which one, but it's a satirical news website, which said, there was no trading on the New York Stock Exchange. Everyone finally had the shares they really wanted. What would happen if everyone indexed? It's such a deeply hypothetical question. I don't think it will ever happen.
At the start of every year, we hear from active fund managers that this is the year for active stock picking, if you like. And of course, it usually doesn't turn out that way. Once again, 2025, have you heard, Tim? It's a stock picker's market. But joking aside, it actually might be, one could argue, because as you've written recently, correlation is low and dispersion is high. Explain what you mean by that and why that might potentially result in richer pickings for active managers.
Absolutely. Look, markets do change, and the way that risk is being expressed in markets do change over time. And if you take a relatively long-term view, and you compare, say, the markets of the mid-2020s to those of 10 years ago. 10 years ago, for those who were operating in markets at the time will remember, all the talk was around so-called risk on, risk off. The headlines largely focused on US interest rate policy. But what tended to happen is everything went up together, everything went down together, and there was less distinction between different parts of the market. 10 years later, speaking in 2025, we must acknowledge that this has changed. The performance of different parts of the market is much more different. This was, very apparent during the lockdown era, when the energy markets started behaving very differently from the technology segments, for example. And to some extent, that stayed with us. We are in a different market environment. Correlations, or the extent to which different markets or different parts of the markets go up and down together in tandem, is behaving differently. That means there is more opportunity for stock pickers, for active managers to generate outperformance by picking those parts that did well. But again, unfortunately, opportunity for glory is accompanied by opportunity for embarrassment. So it doesn't mean that necessarily all stock pickers will do well, but it may mean that the difference between a successful stock picker and an unsuccessful stock picker is more material.
One sector of the market which has done particularly well in recent times, at the time of recording this podcast, is the large US tech sector, if you like, the so-called Magnificent Seven. And this has led to suggestions that index funds are too heavily concentrated in a let's face it, it is a very small number of stocks. How concerning is that, if you like? How unusual is it for that to happen?
So the first thing to point out is that concentration and the ebbs and flows of concentration is a fundamental feature of equity markets and always has been. If we cast a long historical eye, when equity markets began, was the most concentrated that they ever were. When the Dutch East Indies Company launched, there was just one stock on the stock market. Kidding aside, it genuinely is a feature. If you cast your mind back to the end of the 19th century, railroads were more than half of the US equity market. And in fact, US railroads were among the most traded stocks here in the UK and made a significant proportion of what was available to trade as listings on the London Stock Exchange. Railroads were replaced in a few decades, in the US certainly, by oil and the Rockefeller, and then the Rockefeller company, and then its little pieces that it was broken up into subsequently. In the 1960s, it was telecoms. IBM at one point dominated. If you look through the history of stock markets in the US and elsewhere, what you see is individual companies, individual sectors or industries do come to dominate, and that is a really normal part of equity markets. They also ebb and flow. It is very possible that this will happen again, and those few companies that dominate the market today may well not dominate the market 20 years from now. However, and of course, one might say, well, potentially I could take advantage by avoiding these parts of the market that become very large. The challenge on that is it's very, very hard to time. People have been talking about the Magnificent Seven for 5 years now, although it was the FANGs before that. It's very, very hard to pick an advance. Here's the moment when it turns. And there is the option of retaining broad exposure. I don't know what if anything, will become the next company or the next economic segment to come and dominate the US market or the UK markets. But I do know that if I maintain broad diversified exposure, I've possibly already got an allocation. And as that segment grows, as those companies grow, my allocation will grow with them in a market cap weighted index. So there is a natural evolution in concentration and in dominance. There is the potential, if you can time it, to take advantage of it. There may be the potential to, people can choose what they want to do, but it is not a reason to completely abandon market cap indexing, because through those more than a century of ebbs and flows in concentration, the record of indices in navigating through and making sure that they keep hold of new things as they grow is such as to demonstrate that it is a normal part of the market and it's not necessarily a bad thing for market benchmarks.
In a sense, though, this over-concentration argument and the suggestion that because index funds are heavily, or certainly the S&P 500 is heavily concentrated in the Magnificent Seven, that you should invest in active funds instead. It's a red herring, isn't it? Because, I saw some research by Jeffrey Patak at Morningstar recently, and he showed that actually, in aggregate, active funds are the index. That active fund managers, broadly speaking, have just as much exposure to these large stocks as index funds do. And of course, active funds also, because they naturally hold fewer securities, they're more concentrated for that reason. So in fact, index funds are more diversified than active funds more concentrated than index funds.
It's really important to recognize that while different market benchmarks may see different levels of concentration over time, that's not something inherent to the benchmark. It's something inherent to the market. It's really important to emphasize. I mean, look, pick any of the, if you like, the Magnificent Seven, or pick a stock and say that stock is 8% of the S&P 500. What that means is that everyone who is tracking the S&P 500 has 8% in that company. It also means that everyone who is not tracking that index in aggregate has 8% in that company, because the index just reflects what's going on in the market as a whole. Indices, like the S&P 500, reflect what's going on in the overall market. And while it is true that in any individual decision to do something different may prove beneficial, may prove detrimental, it's not the case that, on average, they're all got less exposure to these big companies. In fact, everyone who is not tracking the S&P 500 has, in aggregate, the same allocations.
I always say to people who are worried about the dominance of the Magnificent Seven, for example, why not invest as well alongside the S&P 500 in a small cap index fund, for example, to, if you like, offset that exposure to large stocks. Another way of doing it would be to invest in an equal weight index fund. There aren't very many equal weight funds, but they're becoming more popular. What's your view of them?
The S&P 500 has over 60 years of history, but it is not the only version of the S&P 500 that exists. And another one which has been attracting quite a lot of attention, and we've seen different fund providers licensed for index funds, is the S&P 500 equal weight. That's been around for a little over 20 years. As a former mathematician, as an indexer by profession, I'm rather fond of it. It's a very simple concept. Rather than weight by the size of the company, just equally weight the 500 companies. And that has a intuitive appeal in terms of diversification, in terms of not putting all your eggs in one basket, if you like. And of course, that's not to say that market cap weighted benchmarks aren't diversified. They are relatively diversified, especially compared to many alternatives. But equal weight, in some sense, in a very simple sense, is more diversified. I think part of the reason that we've seen so much interest from providers of index funds and interest from their investors over the past couple of years in the S&P 500 equal weight is that notion that, yes, there is a reasonable degree of, or a historically high level of concentration, and that's not something that one necessarily has to participate in. And there are alternatives like an equal weight index, which will give you more exposure to the other 493 stocks. In terms of long-term performance, over their live history, the performance of the two is actually remarkably similar over the full history, but there are certainly periods when one will do well and the other will do worse. If the largest companies continue to on their record of beating the smaller companies, then a capitalization weighted index will do better. If one might even say when, but I'll stick to if those largest companies start to do relatively worse compared to the rest of the market, that's where an equal weight index will do relatively better. They both, as I say, they both represent diversified ways to approach the US equity market, and they both have attracted fund providers around the world to license, and there are index funds available on both indices in many regions.
Final question. This is a very tough time for the active fund management industry. It seems to be facing an existential crisis. What's your view? Will indexing continue to rise in popularity? And if so, will it reach some kind of equilibrium point at some stage? Will most people invest in index funds in the future? And if so, what kind of proportion are you talking about?
I think the notion of an equilibrium is an interesting one. And I suspect that eventually we will reach some form of an equilibrium where a certain proportion of the market is invested passively, a certain proportion of the market is not, and that's not changing dramatically. However, we do still appear to be in a period where the movement from active investing to passive investing continues globally at a relative pace. So that we appear not to have found the equilibrium yet. What's also interesting is, or for me personally, parts of the market that historically were not traditionally considered to be conducive to the index-based approach, and I'd identify fixed income in particular. That's where we have seen faster growth. It's from a smaller base, which again is suggestive that perhaps overall the adoption in equities is slowing. It's still moving, but it's maybe approaching equilibrium. Other parts like fixed income earlier in the journey. For me, it's fascinating. It's an exciting time to work at an index provider. It's an exciting time to be involved in research, understanding these trends and understanding their drivers. There will, as you say, perhaps eventually be an equilibrium, but this is definitely something that has a lifespan and historically that runs over decades rather than months or years.
As you say, Tim, very exciting time to be in this industry. Thank you very much for your time today. Really appreciate it.
Thank you, Robin.
That was my interview with Dr. Tim Edwards. Thank you to Dr. Edwards and to our sponsor, Timeline. Timeline provides best-in-class planning technology and portfolio management solutions that enable advice firms to deliver exceptional value to their clients. If you enjoyed this interview, why not subscribe? And please leave us a rating. We love to receive your feedback. That's all for this episode. Until next time, goodbye.